Play with the winners. The game is different.
Abundance Stock Advisors. Let's make money.
Hello friends. Welcome to Abundance Stock Advisors. For many such amazing videos, please subscribe to our channel and press that bell icon. And before we start, I wish to tell you that you can download 36 life-changing training ebooks related to overall finance and abundance absolutely free from our website. These books will ensure success in the three most important pillars of your life, that is health, wealth, and relationships. The book titles and the download link can be found in the video description below. Now let's come to the topic. Now investors invest in the markets through mutual funds, usually through the route of SIP. This is common. Fine. Now let's think a little differently from the crowds. Do you know that you can also invest in stocks directly through SIP? Yes, you can do that. In this video, we will see why investing in stocks or equity directly through SIP is a far better and profitable option than investing in mutual funds SIP. You will get to see how 2 lakhs became 40 lakhs in a decent time frame. Friends, you must be thinking that we being stock advisors are biased towards stocks, but that's not the case. It's just a different perspective that we're trying to bring on the table. There will be a big surprise for you towards the end of the video. And ultimately, it's for you to decide which investment is better for you as far as your financial goals are concerned. So to start with, let's see some drawbacks of investing in mutual fund SIP. The first one is, mutual funds are subjected to market risks. An investment in mutual funds, the SIP way, is not assuring you profits. Remember the last line in mutual fund advertisement, which is usually read out quickly. Mutual funds are subjected to market risks. Read the offer document carefully before investing. Let us tell you that most of the large cap equity funds have posted negative returns between 1.5% to 5.5% YTD based on NAVs updated till 13 May 2019. So your investment is definitely at risks in mutual funds. Second, there are costs involved when it comes to investing in mutual funds, which most of the investors do not pay attention to. Let us first understand what these costs are. So the first one is entry load. These charges are levied when the units are being purchased. The mutual fund would sell the unit price higher than the NAV. At present, mutual funds cannot charge entry load, but previously they used to charge an entry load. So if the entry load is 2%, then if you wish to invest 100 rupees, only 98 rupees get invested. A 2 rupees loss right away, even before investing. Second one is exit load. When you sell the mutual fund, the fund house would buy back the units at a rate lower than the NAV. There are no fixed exit loads which are charged. It varies from scheme to scheme. And the current practice is that the funds could charge anywhere from 0.5% to 3% depending on your holding period. If the investors continue to hold the investment beyond the specified period, no exit load is charged. So for example, if the mutual fund NAV is 100 rupees and exit load is 3%, in that case you would just get 97 rupees back, a loss of 3 rupees. The third set of charges are transaction charges. These charges are one-time charges applicable when the money is invested. This is applicable for investments over rupees 10,000. This will be paid to the distributor, to the intermediary who is selling the fund. The SIP transaction charges are deducted over 4 installments, started from 2nd installment to 5th installment. Now the fourth set of charges are recurring charges. These are also called fund running expenses and are charged on daily net assets of the fund. The guideline rates are given by the regulator and mutual funds cannot charge more than the stipulated structure. The expenses are deducted every day from the net assets of the fund and NAV declared is after adjusting the expenses. These rates seen in the table are per annum and expenses are calculated on a daily basis. Friends, now that we have seen some drawbacks of investing in mutual funds, let's see how SIP investment in stocks is different and far better. So the service of investing in equity through SIP is called equity SIP or ESIP. If you are keen to invest in stocks for long term by buying into a basket of stocks at regular intervals, ESIP can be a good solution. Equity SIP helps investors in spreading out their investments over a period of time and create a sizable corpus with small investments. So let's take a look at some ESIP details. Here you can choose to invest at varying frequencies, daily, weekly or monthly. Identify a stock or a group of stock and register for equity SIP. Your broker will do rest of the legwork like placing the order for the right number of stocks at regular intervals, etc. Now, for example, you may register an ESIP to buy say 20 shares of HDFC each month. If you intend to buy shares of 10 companies each month, you have to register all of these shares under the ESIP. ESIP allows you to decide how much amount you want to invest on a regular basis. A broker then buys maximum number of shares that can be bought using that amount. So for example, if you decide to invest 2000 rupees per month, then the broker would buy those many number of shares of HDFC that would fit in those 2000 rupees. ESIP can be modified to suit your needs. You can change your investments frequency of SIP, etc. If you are facing temporary cash crunch, you can pause your ESIP. You can also cancel your ESIP. And to achieve all of this, ESIP expects you to sign a debit mandate in favor of your broker to collect necessary funds from your bank account, obviously. So put simply, you have to keep the necessary amount of money in your bank account. Now, like mutual funds, ESIP too is not a sure success formula. Like mutual funds SIPs, this also comes with a disclaimer that they are subjected to market risks. No investor will get all his bets right. If you buy the wrong stocks, you won't make money. So friends, your stock selection has to be good. Do all your necessary analysis and research and only then invest. Now here the best part is, unlike a mutual fund SIP, there are no costs involved other than brokerage that you pay to your broker. Yeah. So now, here comes the main topic. Let's do a comparison of investing in mutual fund SIP and investing in equity SIP and see which one is really better. So our investor friend, Mr. Rahul, had done SIP of 5,000 in SBI Magnum Mid Cap Fund from May 2005 to 2008. By Jan 2018, he accumulated a corpus of nearly 8.76 lakhs with an investment of just rupees 1.85 lakhs. That's like 4 times in 10 years. Excellent, amazing. Now, had our investor friend Mr. Rahul done SIP of 5,000 in a stock called as 3M India from 2005 to 2008, he would have accumulated approximately 168 shares at 1,072 rupees per share over these 36 months. In 2011, the share peaked at around 4630 and its market price as on 20th May 2019 is 22,975 rupees, thus turning the 1,80,000 into a massive 40 lakh rupees approximately. Friends, no comparison in terms of gains. I have never seen mutual funds move like this. Technically, it's not possible for them. Now, friends, the point is, when you invest in mutual funds too, you take a risk. There is always a risk. When you directly invest in equity, you take a risk too. But there is a difference. The rewards in an equity investment is far better, much higher, game changer. So better invest in equity. Friends, we are not ruling out mutual funds because we deal into stocks. But look at the performance of these stocks. MRF, 50 times in 9 years. Your 1 lakh would have become 50 lakhs in only 9 years. Next, Eicher Motors, 182 times in 8 years. Your 1 lakh would have become 1 crore 82 lakhs in just 8 years. HEG, your 1 lakh would have become 33 lakhs in just 2 years. India Bulls Ventures, your 1 lakh would have become 41 lakhs in just 2 years. There are many more of such examples. Friends, the returns of mutual funds doesn't even come anywhere closer to this. Can mutual funds ever give such returns? Never. We're not saying mutual funds are totally bad, but friends, if you are at a very young age, say less than 50 years of age, this is your time to take risks. This is a good time to build an equity portfolio of yours of some good quality stocks. Select some good fundamentally and technically good stocks and go the direct equity route. Be your own fund manager. Trust us, you are your best fund manager. You understand your financial needs, your requirements, your goals better than any fund manager. And trust us, being your own fund manager is no rocket science. Our clients do that very easily. Yes, in this route, there will be an effort in selecting stocks, but it will pay off in a very big way. We do help our clients build a good portfolio, good equity portfolio. So friends, wherever there is big money, there are big efforts. By the way, is there not an effort in selecting a mutual fund too? So friends, make some efforts in the right direction. Take the risk in the right direction and then just go for it. There is a lot to be achieved. And yes, what a great satisfaction you will get when you have done it. Amazing. I mean, it will build your confidence for life. Some motivation. Play with the winners. The game is different. Friends, hustle with the winners. It's a different environment. The conversation is different. The frequency is different. Be with people who are positive about the markets and make profits in the markets. You will soon become one of them. Friends, just to remind you again, there are those 36 life-changing training ebooks waiting to be downloaded absolutely free from our website. The book titles and the download link can be found in the video description below. For many such amazing videos, do subscribe to our channel and hit the bell icon. If this video has added value in your life, please like and share. If you have any questions, please let us know in the comment section and we will surely reply. Until then, thank you. Happy investing. Jai Hind.